Hi, I'm Geoff Marcus with Alpha Maven. Today, we're going to be continuing our discussion with Charlie McGarraugh. Charlie is the Chief Investment Officer at Altis Partners and also the Chief Strategy Officer at blockchain.com. Charlie, do you expect that we'll see a revenge of the old economy moving forward?
Yes. Okay. So I do agree that we will see a revenge of the old economy. And by that, I think what my former colleague, Mr. Geoff Currie, means by that phrase is this idea of a refocus on capital intensive businesses or direction of capital into bricks and mortar and commodity capacity, right? And I strongly think that that is the pathway forward. Markets for a long time have been focused on dematerialization, virtualization, software, broadly speaking, electrons, not molecules. And with the increase in geopolitical uncertainty, reshoring of supply chains, and supply side constraints, all in some ways related to underinvestment in commodity CapEx, it is likely that markets will be much more focused on molecules and movements of molecules and the costs associated with that, storing them, providing liquidity to them, than in recent years.
Thanks, Charlie. How big will the ESG hurdle be in increasing the cost of capital and supply chain for commodities?
It's a good question. I think it's still an open debate. The market seems to go in waves of even struggling to define what ESG even means. But a few things do seem clear. The first is that a focus on decarbonization is likely to get more and not less through time. Secondly, environmental concerns, whether it's regulatory or literally just environmental disasters, changing demand for various materials in the supply chain as we rebuild or change infrastructure to mitigate and cope with. All those things are likely to impact the cost of capital. I believe it will likely create a lot of government intervention that's designed to direct capital flows into the space to increase capacity. And so the market clearing price of capital may be higher, but there will be instances where the cost of capital gaps lower as a function of government intervention, and trading dynamically around that is likely to be a source of opportunity.
Charlie, how would a super cycle impact a CTA like Altis Partners?
Yeah, so as the markets get more focused on the cost of commodities, there's likely to be a large divergence of opinions and greater volatility, but in the context of greater capital inflows. So we would, see, I think, a broad-based uptrend with higher lows and higher highs, and potentially different volatility regimes. All of which is to say that it'll be a trader's market. You'll probably be paid to commit capital to the space just through the overall upward drift in prices, and the active movement of risk premium associated with this will tend to benefit those who are good at measuring them in real time and positioning accordingly. So being nimble instead of just directional is likely to be very beneficial in the context of a business that's moving a lot of risk premium around.
Charlie, thanks so much for joining us today. We really appreciated having you here. Please join us again as we roll out more interviews and more panel sessions here on Alpha Maven. Thanks so much.
Thanks very much for having me. It's been a pleasure.